I'm Deborah Borchardt, and this is your midday market update. We are seeing the selling today accelerating. The reasons why, well, we got some economic data in quite a bit, actually. The home builder index was weak. The Philly Fed came in. It was weak. We've also seen earnings from retail giant Walmart, definitely disappointing, missing. Kohl's, another big retailer, also missing. So all this has conspired to show us a sector rotation that we're seeing out of stocks and into bonds. And Ben Willis from Princeton Securities is here to tell us more about that. So Ben, we saw that the 10-year yield broke 2.5%. That's a big deal.
It really has most professionals in this business scratching their heads. I don't think of any one person in the market that suggested that the 10-year yield could be below 2.5 at this point in the year. Fully expected to be much closer to 3, if not above 3. But what we're witnessing right now is the sector rotation we saw going on earlier in the month and last month out of some of the high beta stocks and into the safety. So you saw the shorting of the Russell 2000 and going long the S&P or maybe the Dow as a hedge trade. That's all seems to be coming off. It's the entire market appears to be for sale to me right now. There's no safe haven except the bond market, and that was evident in the mutual fund flow numbers that we saw yesterday. Almost dollar for dollar rotation out of equities and into the bond market.
Right. Ben is mentioning the bond flows that we got, the mutual fund flows that we got yesterday, and they did show a big push into the bond funds. We had seen those yields start to drop down. They got to 6-month lows yesterday, so clearly people saw that and wanted to get in on that.
Yeah, but it's to me, what is the motivation? If the central banks around the world are telling you we need to raise our rates and we want inflation, the last place you want to be is bonds. But at this point, with the confusion in the marketplace and the headline numbers of the big name stocks that people know every day and interface with every day, meaning a Twitter or a Facebook or those stocks that they thought they were having great performance in, that's driving that investor to the sideline. I think the professional money managers that are staying in this market are again staying in the safe haven areas, meaning the dividend paying stocks. The utilities have been a much better performer, the master limited partnerships or the blue chips. So if you look at the Dow industrial average compared to most of those other indices, it's actually performed pretty well comparatively. And again, I think that's the safe haven of equities compared to the safe haven of bonds.
All right, well, as we mentioned, we are seeing this sector rotation play out today. NASDAQ definitely suffering quite a bit. The Dow down about 140 points right now. That's Ben Willis from Princeton Securities, and I'm Deborah Borchardt with The Street.